Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, and welcome to Business Line's State of the Economy podcast series. This is the sixth of the podcasts focusing exclusively on the markets, and this series on markets is coming to you regularly towards the end of every month. Bringing insights from experts on the subject is your host, Parvatha Vardhini. I am the editor of bl.portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker for this month is not from the equity markets as it has always been, but this time he is from the debt side, Rajeev Radhakrishnan, CIO Fixed Income, SBI Mutual Fund. Rajeev is an engineering graduate and holds a master's in finance from Mumbai University. He is also a charter holder of the CFA Institute, USA. Rajeev is a veteran of SBI MF, having joined the fund house as a fixed income fund manager in 2008. Hello, Mr. Rajeev. Welcome to the podcast.
Hi.
How is 2024 treating you, sir?
Oh, yeah. So far, so good. I believe this is markets are going to be quite challenging going forward.
Right.
So exciting times lie ahead, I believe, in 24.
Okay. So I thought we could start with an equally important question for 2024.
Sure.
A lot of guesses on whether you're going to have a rate pause or a rate hike perhaps in the second half because, you're still not sure of inflation, vegetable prices going up, or, could it be an outlying cut? So what is your take for the repo rate in 2024, sir?
In fact, a good question actually to start off this discussion because I think in terms of the setting the context, the last quarter of 23 was really, I would say, you saw a significant repricing on expectations on rates, more so globally, maybe to lesser extent in India. So I still remember, I think, unfortunately, markets have a very short memory, I believe, because not so long back, 3 months back, I think October, we were talking about rates staying higher for longer.
Right.
People were worried that the Fed may have to hike more. And then you had a complete about turn. So the higher for longer thesis got thrown out of the window and people started pricing in large rate cut expectations for 24. But I think interestingly, over the last couple of weeks, I think in beginning of 24 in a way has started in a way sort of a bit of pushback has come to that thesis that rates can go down so fast or so early as markets have been expecting. So I think in terms of expectations, we still have expectations in the market or in terms of market pricing. I'm talking more from a global perspective. I'll come to domestic because both are to some extent to, at least markets seem to be completely interlinked. So the global expectations have gone from pricing in a cut in March. I think 100% was priced in three weeks back. Today, probably markets are not really so hopeful. I believe a 40% possibility is what when I last saw the market price. And I think around 5 cuts or something are priced in even today. So setting the context for 24, I think the biggest source of volatility and probably biggest source of disappointment might come in from these excessive expectations that have got built in market pricing. So we don't see the Fed being in a hurry to cut rates unless there is a collapse in economic activity. So far, you've seen economic activity holding back relatively okay. Inflation is gradually trending down to targets. So this is what that soft landing, I think the Fed probably is getting it right. But will they be in a hurry to cut after having completely misread inflation? And even today, inflation is expected to stay above target for the foreseeable future. So my expectation for the coming year from a global context would be less cuts and later. So, I don't think we see cuts in March. Probably given that, you have a soft landing type of scenario that is unfolding, maybe at some point down the line, the policy rates may not need to be as high as it is today. So I think that is what the dot plots are indicating, that you still are away from inflation target, but given that the bigger worry on inflation has sort of tapered off, would you want to keep policy as tight? So I would bet on markets actually getting only the extent of cuts that the Fed has given in their dot plots, not the extent of cuts that the markets have priced in. So as we go forward, that can be a source of disappointment and source of volatility. Now, coming to domestic markets, I know that there has been, there is a bit of expectation in certain quarters that the RBI will follow the Fed. The Fed will cut and then the RBI will ease. And I think that is not likely to happen simply because of the fact that domestic monetary policy will respond to growth inflation dynamics domestically. I don't see a clear-cut reason for the RBI to ease policy until they get clear comfort that inflation is guiding close to the midpoint. So even today, I think the average expectation on inflation for the next fiscal is about 5. And growth has actually held up extremely well in India. We've also been positively surprised how, this financial year you're looking at closer to 7, in line with what the RBI had been projecting all along. And earlier we were under the expectation that growth would be below 6, and that is not translated into that, right? You're seeing growth fairly robust. Inflation, unfortunately, still away from target. So that effectively means that the RBI will continue to be conservative in its policy stance for this year. As a base case, if you ask me, I'm not expecting rate cuts from RBI in this calendar. What is more likely to happen is as you go into the second half, as and when we see visibility that inflation is at least closer to 5, which is likely, given that you have both the lag effects and some of the base effects also will play in. So as you see that range of inflation, and hopefully by that time, the global context also could have been more clearer. I think the Fed will probably ease policy in the second half. So as we see that dynamics play here in India, the liquidity stance of the RBI can shift. So today, actually, over the last 4.5 months, what have we done? We've not hiked policy rates, but effectively, the policy rates are 25 basis higher than what it was 4 or 5 months back. So you're operating at 675 on the overnight collateralized segment and somewhere between 85-90 on MIBOR. So the effective, the operating target for monetary policy is actually at 675, 680, which is an indirect rate hike that the RBI has done. And the reason being simple, because you still have inflation, which is way above control, or rather way above target. So this is one shift that can happen. As you see, visibility of inflation aligning at least around 5. And probably by that time, the global context also would have been a bit more clearer. I think the Fed would probably move by that time. Possibly the liquidity stance of the RBI will shift. And it is required also because you're seeing the excess liquidity getting really unwound in the system. And if this sustains for the next few months, you might potentially lead to a situation where RBI may have to infuse primary liquidity. So that shift is likely, and that is what we are anticipating at this point. I'm not really looking at rate cuts in this calendar. A lot needs to fall in place. Rate cuts in India can happen if there's a growth collapse, which is unlikely at this point based on high frequency data. The second angle is you really see inflation coming, aligning closer to target. And I don't think at this point when growth is extremely robust, and this is a time when RBI can actually really go for its midpoint target. So I don't see them relaxing on the inflation mandate if growth is fairly okay. So that's the expectations for this calendar.
Okay, so more likely a pause is what you are saying.
Yeah, an elongated or an extended pause is a base case with a potential shift in the liquidity stance over the year, and rate cuts probably will have to wait.
Okay, sir. Coming up for FY25, this big event, the JP Morgan index inclusion.
Yeah.
To what extent then do you expect the yields impacted by these two events?
Last calendar, I think we got something like 7.5 billion or so net inflow into FAR government securities, which is purely due to, and because all the flows happened after September, or rather leading into in the last quarter mostly, because announcement came in September. It was there in the news in the sense that JP Morgan is reviewing it. So the second half is when all the flows started coming in, and it's likely that as the index, and this is something that you see in every jurisdiction. China, I think, is a recent example where a lot of overseas flows, index tracking flows came in before the actual index inclusion date, because a lot of investors do that whatever pre-investment or pre-positioning before the larger flows. And in our case, the numbers that we keep hearing about 15, 20 odd $billion, I mean, it can be here and there, but directionally, yes, you will see global investors participating in government securities in India incrementally, given this is a big positive factor. So from a demand side, the JP Morgan index inclusion, as I said, is already playing its part. We are seeing constant flows, and that's one reason why our yields have been relatively stable in recent past. Even as the treasury yield has started backing up, it has gone from 380 to 414, 415, and our bond yields are at around 718, 720. So it's largely due to the fact that there is a layer of demand that is coming in constantly. Small amounts, but it is coming in almost every day. So that is positive from a demand side. But eventually, a lot more, when you look at a bit ahead, if a lot of flows come into India, even if active flows come in, and maybe if other index providers add India into the index, to the extent that RBI stance remains anti-inflationary, we need to see the impact on bond yields will be a function of what the RBI's response would be on the liquidity. So at this point in time, they want to actually take out rupee liquidity, or that is withdrawal of accommodation. But that is, I think, incrementally reached a stage where liquidity is fairly tight, right? I know at some point maybe they need to revisit, but if you have a situation, say over the year, if both debt and equity flows are coming in and RBI is faced with a challenge on the maintaining the currency, in the sense that they intervene, and if that adds rupee liquidity, and if the policy stance is still anti-inflationary, they may have to sell bonds and suck it out. So the net impact at this point will be a function of how the eventual RBI sterilization operations pan out. But at a very basic level, yes, it is positive because you're seeing new demand.
So, sir, net, what you're saying is the 10-year yields at 7.5, 7.6, which we saw in June, July 2022, we've had in recent times.
Oh, yeah. It looks likely, very clearly, because June 22, I think we were just about starting to tighten, right? And the Fed was also doing just about in the early stages of tightening. A lot has changed. We are definitely, the Fed is done with tightening. We are also, we still have a distance to cover in terms of inflation, but quite likely that in India, the policy rate is unlikely to be. Of course, you can't rule out anything, but as a base case today, you should assume that rates stay higher for a bit longer rather than even going higher. Theoretically, even that's possible, because if growth is so strong and RBI is really resolute in getting down to 4, you can't completely rule out. But I mean, as a base case, I would say, okay, you're done. You will stay there for a longer period. So in that context, and now with new developments like JP Morgan inclusion, the Fed is done, maybe they'll start cutting so more flows can come in. So overall, yes, that those peaks are unlikely to be revisited in this cycle is what I would assume today.
And if you see, because, the yield curve as such, it's extremely flat. So because of your liquidity crunch, the shorter term, right, and as well as the longer term is that, as you said, 718, 720. So, I mean, why is it so flat, and how do you expect it to be the rest of the year? Is it going to get better the rest of the year?
Yeah. So the flatness in the curve, again, it's a function of how liquidity dynamics have played out. As I mentioned earlier, the RBI is operating the system at the upper end of the LAF corridor. And I think that gives a lot of optionality to them, because you need to assess how much you've moved from. I mean, the way I look at it is I don't see policy rates having gone from 4 to 6.5, because 4 wasn't relevant and 6.5 isn't relevant today. When we were at 4, the effective rate was 3/4 because you had surplus liquidity. So we've actually moved from 3/4 to 6.75, not from 4 to 6.5. So in that context, it's essential that they have to assess whatever lag effects are there. And I think the tightening is now done through liquidity, and liquidity surplus has substantially been wiped off or narrowed materially. And it's expected that this tighter liquidity stance may sustain as long as RBI does not have comfort on the way CPI broader, the headline is moving. So, and that's the reason why the shorter end of the curve has stayed elevated. Alongside that, when you look at the money market space, a lot more of issuance of CDs have happened because banks also, there's a gap between deposit and credit growth, and credit growth has been fairly robust, deposit is lagging, and to that extent you have a lot more of funding through CDs and bulk deposits. So it's the interbank liquidity dynamics and the RBI's operation on the liquidity side, or effective tightening policy through tight liquidity, which has kept the shorter end elevated. The long end, of course, has reacted to developments like index inclusion, the flows, and expectations that markets have on the longer term rate trajectory. Because, you have, as I said earlier, there's a bit of expectation that the RBI will follow the Fed. So to that extent, we've seen the global yields have come down, and our long end also has. So demand supply is again an important factor. One thing that I mentioned was the JP Morgan or the offshore flows. That has largely been in the 5 to 10 year segment of the curve. The long end of our sovereign curve has been anchored by good demand from insurance and pensions. So there are these specific factors that are apart from the rate cut expectations that it is there, or the peak of rate cycle expectation. It's demand supply that has sort of kept the long end fairly anchored, and the shorter end has reflected tighter liquidity and tighter monetary policy stance. So as we go forward, as I said in the beginning, the first unwinding will happen on liquidity. That should lead to the shorter end moving lower. But in India, we have always seen there's a parallel move first, and then eventually the curve will steepen out. So I think this will be similar this time as well.
Okay. And the very important question for investors from all this, do they play duration now, or do they play accrual now?
Yeah. So overall, I would say it's a function of what risk appetite you have. So if you are not really an investor who has appetite for interest rate risk, the short-end accrual, even on high-grade bonds, is very, very attractive, right? You got your 3-year AAA PSU, PFI bonds around 775, 780, and you take NBFCs and all, they are 8-quarter. And, so you get a reasonably high carry close to 8% on a high-grade 3-year or even a 1 year. The curve is flat. So with high quality bonds, you are able to get very good accrual today. So again, investors who don't have the risk appetite on duration can be very well served by moving at the shorter end on high grade bonds. Duration is a story that will play out as you go forward, as I said, over the next 12, 18 months. So in the near term, you can have one volatility on both sides. Last 3 months, we've seen the long end, rates moving down. As the external expectations on rates get repriced, you could potentially see a little bit of uptick in the near term. But directionally, as I said, are we seeing rate cuts immediately? No. But as RBI gets a more visible handle on inflation aligning closer to the target, I'm sure at some point down the line, there could be a change in the monetary stance. So duration can play out over that timeline. So today, to answer your question, I don't think there is like a clear cut, it's purely a function of what risk you can take. If you are not an investor who wants interest rate risk and volatility, you still get close to 8% carry, and you're not going to lose money investing in high grade portfolio at today's yield levels. At the same time, the duration benefit can come if you have a tenor that is exceeding 1 year. So I think it's just a question of that, your risk appetite and what tolerance in terms of, or rather what tenor tolerance you have.
Yeah, that's what we have also been writing about. Say there is an opportunity for every investor and at every
investor,
every tenor in debt actually.
Every tenor. So even if you are a liquid fund investor,
right.
in fact, the way the shorter end is moved, I was told yesterday 3-month CDs are at 785. And today the T-bill cutoffs also came 3-month above 7%.
Correct. Yeah.
So the levels are extremely lucrative. It's just a question of what segment you are comfortable and what liquidity requirements you have. So
moving to target maturity funds. So Now, for you as a fund house, how have these funds done post your, losing out on the tax advantage, and in what ways do you say that these funds still make sense for investors?
Post the tax changes, we've not seen flows in these products. In fact, the 1 week when you had before the tax changes became effective, a lot of money, you're sure you would have seen that, right? A lot of money came into all these products. So after that, people have not really come back into any sort of duration products. It's largely been at the shorter end, which is largely institutional flows in nature. So investors have not really come back into some of these categories. Probably they are waiting, and I think this is going to be the case because earlier you had investors who would have come in. Of course, people do try to time, but once they have entered, they typically stay for that indexation, the 3-year tenor. So today that is not valid anymore. So you will still want to time, right? They will say, okay, let me come in at the peak of or maybe whatever. I mean, depending on what
For
view you
example,
have.
today if I see your SDL or the PSC bond plus
Yeah.
SDL fund, the YTMs are 7.5,
Yeah.
7.6 as per your latest.
Right.
So
Right.
even for somebody who wants to enter that fund today for a short term, probably it's not a bad
So
idea.
people, I would say, so the change in behavior would be that they will become more tactical, and probably the tenor of investment also may not, will be accordingly shorter. Now, but to answer, in fact, we don't really talk much about valuations in fixed income, and I think it's a time, really we need to look at that as well. When these funds were being sold and a lot of money was coming in, the valuations were not favorable. If you go back in time and see, most of the flows came in at the time when RBI was still about to start, or they had just started off hiking policy rates. Today, after moving from 3/4 to 675, we have definitely at the fag end, or you're done with tightening. And the second angle, which is again not really appreciated, is when flows were coming into some of these PSU underlying portfolio, the TMF, the spread was not there. You had at that point, because of excess liquidity, high grade corporate bonds in certain segments were trading below SDL. And I even know of instances where a PFI and a PSU bond has traded below GSEC. At the shorter end. Why? Because money was coming into these funds. These funds had to buy only these sort of bonds which are there in the index. And unfortunately, at that point, the bond supply was not there. Because all the issuers were going to the bank loan market, because the loans were coming at extremely attractive levels, right? I mean, people had moratorium on repayment. You had T-bill plus and repo plus structures. So corporate, especially PSU issuances, migrated there. Today, that has changed. A lot more of supply has come in. Bond spreads have widened. Today, unfortunately, at 60 basis spread over a sovereign, money not coming in because the tax changes happen. So both from the angle of, if you leave aside the taxation part, from the perspective of where we are in the rate tightening cycle and where we are in terms of valuation. And by valuation, I mean, I think I missed one part. So the two parts to valuation, I would look at it. One is the bond spreads. So you were having zero spread or negative spread at some point. Today, the spreads are reasonably wide. In fact, it is higher than the long period average. So spreads are getting attractive. It can widen further. I'm not disputing it. But clearly, from where we started 2 years back, the spreads are attractive. And the other angle of valuation is real rates, right? Today, even if you say that inflation will be 6, which is unlikely, we are saying 5%, and you're buying these 1-year bond or 3-year bonds at 8%, you really have visibility that even if you shock it by 1% and say 6% inflation, you're still getting real positive rates. That wasn't the case 2 years back, 3 years back, when money was coming in. At that point, you had 6% inflation and 4.5% yield on certain corporate bonds, or 5. So the whole scenario has changed. So leave aside taxation, from the monetary policy angle where we are and where we are in terms of bond valuations, in terms of real rates and spread, it is very, very attractive today. So I am sure, I think investors can be, so if you don't want to take that fund manager risk, that, okay, you come in an actively managed fund and the fund manager takes, it can happen, right? I mean, you take a call and the market goes against you, but the investor thinks that, okay, I'm here for accrual and I can actually time my exit, because tomorrow, if liquidity eases, and bond yields go down or spreads tighten, you will get capital gain if you want to exit. So you are taking that call. So the target maturity fund is giving you that flexibility to play your view. So I think it's a good product for those investors today. So taxation, of course, hopefully the budget will address it in some way. I don't know. I'm just speculating.
Okay. My next question was on the spreads, but I think you partially answered
Yeah.
that also. So the spreads are better today than 2 years ago. That's what you would say.
Yes. Except the 10-year, I would say. The 1 year, 2 year, 3 year, 4, 5, everything. The spreads have gone from almost nothing, 20 odd basis on an average, to as high as 50, 60 bips. So I
On
think it's
both
getting
PCs
attractive.
and corporate bonds. That's what
I'm talking about PFI, PSU, and corporates come later.
Okay.
So there is enough, I would say, even on the possibility that you might see a bit more of widening, because a lot depends upon how the capex cycle plays out, and if a lot more of corporates come in, start tapping the market, and then liquidity remains tight, you can see spreads widening further. And from a starting point from zero spreads or tight spread to spreads which are today slightly higher than long period average, I guess it's a fair bit of progression. And I think investors should be looking at it actively is what. And the other reason why it looks all the more, again, that comes from the view. So as I said in the beginning, the best case that we can see in terms of policy settings in India over the year is a shift in liquidity, right? From a policy-induced tight liquidity regime, you could potentially move into a policy-induced neutral to little bit surplus as the year goes by if we see this improvement in inflation, and that can benefit this segment materially.
Okay, so one last question. I think you already answered it. So
Yeah.
The thing is, you needn't necessarily go down the credit curve this year, isn't it? That can be the
Not necessarily.
message.
Yeah, precisely. There are enough opportunities in the high grade space,
Right.
and I think, and eventually, yes, opportunities on down the curve will follow, given that everything gets priced over this. So at this point, I think there is enough opportunity in the high grade space to take advantage of.
Thanks a lot.
Okay. Bye bye. Thanks.